Welcome, everyone. We're going to be talking today about deducting work-related expenses. So just give me a second. I had to turn on some lights there to get everything nice and clear for you guys. We're going to talk about deducting work-related expenses. And the reason why I'm bringing this up one more time this year is because when on my blog, when I have analytics, things through Google as well as through WordPress, the thing that I notice is that the number one topic that is being searched that drives people to my blog right now is actually questions related to this. Can I deduct my work-related expenses? And more to the point, I know I can't do it because the rules have changed, but how do I get around it? Because I have a lot of work-related expenses. Now, there are solutions here that can be used to actually deduct these expenses. But it's not always as easy as it was in the past, but in a way, it's actually better. There's something called an accountable plan, and that's what we're going to go into here. Employers, for the most part, don't like to do this if they haven't, especially small employers, but I want to show you this so that you can show your employer this very same video so they understand that this is beneficial not only to you as the employee, it's beneficial to them as the employer. So, let's get started talking about what an accountable plan is. An accountable plan, and I'm just going to read it from my book right here. So it's just, I actually have a quick finder. So I don't know if you guys can see that. I mean, it's a short, sweet, to the point explanation. And then I'll tell you what an unaccountable plan is and what it means. And then we're going to go into some details and a real simple illustration of how this would work and how it would benefit both you and the employer. So an accountable plan. Employer reimbursements for an employee's business expenses are deductible by the employer and not included in the employee's income. The expenses must have a business purpose and be substantiated by the employee. And the employee must return any excess reimbursements within a reasonable period of time. If the expenses are not substantiated or excess expenses are not returned within the required period of time, the expenses are treated as paid under a non-accountable plan. Non-accountable plans are listed as employee expense reimbursements made under a plan that does not meet the requirements of an accountable plan are considered made under a non-accountable plan. Reimbursements made under a non-accountable plan are taxable wages to the employee. So that's why if your employer is going to reimburse expenses, it has to be done correctly. The employer gets a deduction and you don't have to pay tax on the money. It's basically tax-free income to you. It's a reimbursement, and some non-cash deductions like mileage can be quite significant. Now we need to touch on a few of these things here, what this terminology means. Excuse me. So what we have here is the expenses must have a business purpose. And that's kind of intuitive. I mean, it has to be work-related expenses. So let's say, for example, if you're a mechanic and you have some tools and your employer reimburses you, it's dollar for dollar. That would be an accountable plan. Any reimbursement is considered that. If you have things like spiffs or mileage or things of that nature, then there would be some additional ability to be reimbursed for those kinds of things. has that expense related to business. But we're going to go into this in the example. The employer can do this two ways. You can have receipts and you can turn them in every so often, let's say monthly or quarterly, and then the employer just says, here's a check, and you can have that. The second way of doing it, and this is really nice for the employee because you're already putting money out of your pocket, is the employer may say, I'm going to give you $1,000 per month under an accountable plan, and then you have to turn in your receipts in a reasonable amount of time. And so monthly or quarterly, usually monthly is the way this is done. So every month you turn in your receipts, and the employer then would say, okay, I paid you $1,000 per month, but if you paid in a little bit, if you had more expenses, that's on you. That is something that is no longer deductible. And if you have more, the employer under an accountable plan generally does not have the ability to deduct, though they can reimburse for many things regardless of that. The employer's attitude can certainly be, I can deduct all the expenses that are business related, and the employee gives this to the employer, and then the employee is reimbursed, the employer gets the deduction. Why is this important? Why is this Why is this the preferred way of doing it, even before the tax law changed? Well, first of all, under the old tax rule, you could deduct the expenses only if you itemized, and the first 2% of adjusted gross income didn't count. So if you had $100,000 of adjusted gross income, the first $2,000 wouldn't even count. And you had to still itemize. So if you didn't itemize, maybe you paid off your mortgage, you don't have much in charitable contributions, property taxes weren't enough to get you there, estate taxes. It becomes very clear very quickly that you're not going to be itemizing. So if you didn't itemize, it didn't help you at all. Under the accountable plan, with the employer reimbursing you, the difference is this. The employer paid you, let's say, $100,000 per year, and part of that paycheck was that you would pay for your own expenses. You can deduct the money if you want on your own. That's okay. However, when the employer reimburses you, that is a deduction to the employer, and it's not a wage to you. It's not reported anywhere. The reason why that's important is there's no FICA tax. There's no and in your case, self-employment tax for business owners, but there's no FICA tax. There is no workers' compensation. There's no unemployment insurance on this. There's none of the extra fees that employers have to pay. So keep in mind, the most easy one to understand is FICA. FICA is 7.65% for the employer, 7.65% from the employee. So if you make $100,000 in a year, $7,650 will be withheld from your paycheck for Medicare and insurance, and then the employer doubles that. So if the employer says, you know what I'm going to do? I'm going to have an accountable plan. And I'm no longer going to include that. So instead of giving you a raise, or maybe we're going to adjust your paycheck accordingly, we're going to say that I'm going to pay you $90,000 a year and not give you a raise. But what's going to happen is I'm going to give you a $1,000 accountable plan stipend. And normally, if you would have these kinds of expenses, it would be a profitable venture for you, because you would pay less less FICA tax, and the employer would also pay less FICA tax as well. I want to make sure this is coming through and everybody can hear as well. I got a little green dot on my screen here. Let's go ahead. I'm going to put something up here for you guys to look at. I put this little chart together here showing an employee in an example. So over here on the side where you'll see that the 2018 and the 2019, this is the mileage rate. That's why I marked it in green, so you can see where it comes through. So let's say, for example, that there were some spiffs of $128 in January of this year, and this works for last year too, by the way, if it was set up. Your mileage, let's say there's 1,268 miles. And let's just assume that you're either a mechanic, and maybe you do some traveling for the employer. Maybe you have some spiffs, some things that get given away, or some things that you use for getting people to become clients of the company. And then, of course, you had some tools in here. So we just auto sum this up here together. You had $1,331.44. Now, let's say, for example, that the employer normally gives you $1,000 per month in a reimbursement. Let me just get this out here so it looks nice. So you get $1,000 of reimbursement. That's your money to keep, as long as you have enough receipts to turn into the employer. Now, if, for example, the employer, let's say, gave you $2,000, now you don't have enough receipts. Now, if you read the directions here, what it says that you must return excess reimbursements within a reasonable amount of time. Reasonable amount of time would be no less than at the end of the year, the tax year, so a fiscal tax year. So you get to December 31st, if you receive $1,000 per month, $12,000 of stipend, you then should have had $12,000 or more in deductions. In receipts that were for business use that would offset that. If, on the other hand, you don't, let's say it's only $10,000, you have to return $2,000 of that before the end of the year. Otherwise, it's considered a non-accountable plan, and that is considered wages for you, and the employer still gets the deduction, but it will still be subject to the self-employment tax. I'm going to try something else here, see if you guys can see this just as well here. I don't know if I like that either. I'm still playing with some of this Facebook stuff here and some of these videos, so I hope that it's seeable. So let's take, for example, here. So we're just going to do an auto sum here. So let's say this is all of 2019 instead. And actually, it wants to turn everything to a dollar sign now. We're not going to mess around with that, but there's certain codes that you can put on there for sure. So we'll just put January back up here. The difference between these two, if this was for a full calendar year, I know what to do with this. 2019, there we go. Still wants to do it on me. Let's do this. 2019, will it do it there? There we go. So tax year 2019. If this was the whole actual year of expenses, and the employer could say to you, because you turned in 2000, or you turned in 13, let's go backwards. Let's go back to 1,000. If you had 1,000, if the employer reimbursed you $1,000 during the year under a stipend, and you had $1,331.44 of actual expenses you turned into the employer could either say, too bad, so sad, you lose that, or the employer can say, that's okay, I'm still going to cover that anyway. And it's totally up to the employer. But there is no deduction from 2018 forward until they change the tax code. So that extra $331.44, not deductible anywhere for you. It is deductible for the employer if they reimburse you. So that is a nice incentive for the employer to do that. Also because the employer is not paying any self-employment tax. Now, if we auto sum this here, let's see what we got. So Terry has some questions. I'm going to get to some of those in a second. Okay, I'll get to that in a second, Terry. And I'll read those questions out because I take these and then I put them on YouTube when I'm done. If the employer gives you a $2,000 stipend during the year and you only have $1,331.44, now that is too much. You didn't have enough receipts to offset it. You would have to, let's see if my auto sum will grab this correctly. And oops. Let's do this. Equals and we're going to go we're just going to go like this. Make equal this minus. So you had $668 more in stipend. You would have to return that by the end of the year, or if the employer has a written plan that says it's monthly or quarterly, you would have to return that $668.56 immediately or at the end of the year to the employer. Otherwise, your accountable plan becomes a non-accountable plan, and that's bad for you, a little bit bad for the employer, but more bad for you. So you certainly want to follow those rules. This could be a monthly, this could be an annual. Now, if it's a monthly thing, the employer can say, we can catch it up later. So the employer can say, I'm going to give you $1,000 per month. Some months you might have $600, $700, $800. Some months you might have $1,500. Especially if you're a salesman on the road, those numbers can go quite high or quite low depending on how much mileage you have. At the end of the year, you can net everything out and say, oops, the employer owes me a little bit more. The employer then can choose what their plan says for reimbursing you for that. If there is too much paid to you, that would have to be paid back, or it becomes a non-accountable plan. So we don't want that. So let's go into some practical applications above and beyond that. And I'm going to go to Terry's question. So Terry said, I was under the impression that the 2018 tax law removed these deductions and that my home office, for the convenience of my employer, who provided me no workspace expenses, are no longer subsidized by the code. And the answer is yes and no. The answer is, if your employer says you must provide an office or some office space for the convenience of the employer, you cannot deduct it on your tax return. However, if the employer reimburses you, it is tax-free to you. It is deductible to your employer. Your employer may wish to adjust your paycheck accordingly. So the employer might say, well, the cost, and you can do it, you can just do office in the home just like you normally would, actual cost. Or you can use the safe harbor, which is $5 per square foot up to 300 square feet, $1,500 per year. Or you can actually treat it as a rental. So you're renting out your office in the home. So your employer might say, I'm going to give you $500 per month. And then your employer then is not necessarily reimbursing you for the home. They're renting the home from you, that room, that office space from you. And if they pay you $500 per month, that would be rental income on Schedule E, and you would take all the deductions along the way as you would with any other rental property. Or very similar, for example, let's say like an Airbnb that has a partial home or a room being rented out. Not exactly like an Airbnb though, but somewhat similar. So the office and the home, for the convenience of the employer, is still deductible, just not on Schedule A, subject to 2% of adjusted gross income, or the Form 2106, which basically flows right to that part of the tax return. If you structured this correctly, and all parties have to be on the same page, if you structure this correctly, and the employer and the employee agree to this, they both can benefit from it. And for example, again, if you have an office, if you're providing an office in the home and there's no deduction for it anymore, and the employer says, well, if you're going to provide an office in the home, I'm going to pay you $6,000 a year less, but I'm going to pay you $6,000 in rent, because before, part of your paycheck was inclusive of you going out and getting a rental property or getting a place to stay, office in the home in this case, for example. So you would certainly have that option available. When I have small businesses come to me, it's very common for me to tell them, why don't you get an office in the home? And especially if you're an S corporation and you rent basically from yourself, is what you're doing. It's a self-rental. And you would then charge a fair market rental rate. You want this. Your employer wants this. Your employer wants you to charge them a fair market rental rate for the office and the home for their convenience, because it's to their advantage. They're going to pay you less money on a W-2, which means less FICA tax for them. It means less FICA tax for you, and you get a deduction for the property as well. You can do it dollar for dollar, so there's no reporting on your side, but a total deduction for the employer, or you can treat it as fair market value, and then you would deduct your expenses on Schedule E as you would any other rental property. So I hope that helps, Terry. That's really what it is. It's the code doesn't really say that you can't do it. The code says there's just no space to put it anymore. There's no place to deduct that, because the 2% adjusted gross income deduction on Schedule A is gone. Some states still allow it. Not every state has followed the Tax Cuts and Jobs Acts of 2017 when they did that. So your state rules might change, but most states, in fact, I think every state that I'm aware of, I don't think there's any state that does not follow the accountable and non-accountable plan rules, and the self-rental of your office in the home as well, too. I don't believe that there is any state that works against that. So hopefully that helps. If there's any other questions, you can let me know quickly. I meant this to be a fairly short to the point video. Hopefully, if you have employers that have questions on this, they can grasp what I'm trying to do here pretty quickly and realize the tax benefits to them. So, $10,000 moving from a paycheck to an accountable plan can be worth $765 to the employer, $765 to you too, just in FICA tax. But it's also going to be an advantageous because they get the deduction regardless anyway. And you weren't getting a deduction, and it was always truncated in the past. You would now be able to get a full deduction because of that, because it's basically all being reimbursed, no out-of-pocket money. So if anybody has any last questions, I know we only have about 20 minutes in this, but I wanted this to be quick and short to the point, because on the blog, on the Wealthy Accountant blog, it has been the #1 search engine question, a search term that has been bringing traffic to my blog. It's been a huge growth area, and everybody I know has the question. It's a big problem. People have the issue. So I discussed this before. I also have, if you want to look at this also, we can also do this here. Let me show you this. I had a blog post on this about a year ago, how to deduct unreimbursed business expenses without itemizing. I don't really get into the accountable plans as much, but I talk about other ways you can work around this, especially if you have things like partnerships, things like that. Hopefully, every one of you should be able to find a way to get those expenses deducted. And if we can get those expenses deducted under the new rules, It's just a matter of semantics. They just made us jump through a different hoop. Before, you had to fill out 2106, track it through to Schedule A, and then you had to itemize. This is actually a better way. So I was encouraging clients to do this even before the tax law changes. Now with the tax law changes in place, it's much more motivating for these people to do it, because you get no deduction unless you take this policy. So I think what I'm going to do then is I'm going to call this a day. I'm going to add some of these links here for you guys. If you want, I'll include the link. I actually have a video. So if you actually look at this here, there is another YouTube video right in here where I talk about some of this, including accountable plans, and hopefully I can, that will be clear for you. Let me see if I have anything else here that I can share on that. So no, that should be it then. So hopefully that answers your question, Terry. I hope that any of you that watch this, whether it be through the Facebook or the YouTube video, because I'll drop this into YouTube as well. Hopefully you can look at a few of those links, which I'll add after this is done. Within 20 minutes or so, it'll be there. And hopefully from there, you can convince your employer that this is good for them, because it's also good for you. You guys have a great day. Hopefully tax season is good. I'm probably in the next few weeks going to put together a Q&A session where we're going to actually do these live events, and I'm going to probably spend a little money to boost it. Thanks for another great session, Carlene. Yes, absolutely. Thank you for stopping by. I'm going to do a Q&A session, so kind of consider it. I think these Wednesday mornings are kind of nice for my schedule. I hope it works for everybody else. When I set them up, these Q&A sessions, these are for you. I'm not going to come in with a pre-programmed presentation. You come with your tax questions while you're preparing your tax return. Because I don't take consulting sessions except for regular clients during tax season. In fact, from January through end of May, I don't take sessions, any consulting except with clients. You guys have questions. You still have these meaty questions. Accountants don't always answer the questions. If you're doing it yourself, it's sometimes hard to find an answer. And sometimes what they say online and even in the IRS tax books are not as intuitive as what the real world practical experience would indicate. So keep that in mind. If you can't attend the 10 o'clock in the morning sessions, you can come to Facebook. You can see the actual event. You can put your questions in there in advance, and then I will have a list of questions ready to go. And when tax season coming up here, I'm sure with these new tax law changes, there's going to be a lot of questions from you guys. And I want to make sure that you don't lose any of your deductions. I want you to pay the least amount of tax legally. And I just want it to be a smooth transition, even though the IRS, as I'm recording this, is kind of shut down right now. Hopefully we can make this smooth for you and iron out some of these bumps, and maybe some of my experience can actually work to your advantage for that. So you guys have a great day, a great week, and we'll see you probably next week then. Look for that Q&A session, and you guys take care. I love having you here. Bye now. Oops.